Hi, I'm Rick Kaler. Thanks for joining me. Last week we explored how you could use a reverse mortgage to produce an income for life while allowing you to live in your home until your death or you move out. We also explored the possibility of using a reverse mortgage to refinance an existing mortgage, thus eliminating a house payment and possibly creating additional monthly income. This week, we'll explore a few more creative ways to use reverse mortgages as suggested by Michael Kitces at Kitces, KITCES.com. While most of us think of a reverse mortgage as a way to unlock equity in a current home without having to sell it, Kitces points out that another use for a reverse mortgage is buying a new home. While the buyer will need a larger than normal down payment due to the lower lump sum limits of a reverse mortgage, this technique can be used to increase cash flow while downsizing a home because there will be no monthly mortgage payment. This is how this might work. A couple owns a house worth $300,000 with a $125,000 first mortgage. The monthly payment is $800. They'd like to downsize to a smaller home, say costing $200,000. One option is to sell the current home and use the proceeds of $175,000 to buy the new one and obtain a traditional $25,000 loan with $200 in a monthly payment. But another possibility would be to use $100,000 of the sale proceeds as a down payment on the new home and finance the remaining $100,000 via a reverse mortgage. The balance of the proceeds of $75,000 would go into a portfolio and generate $300 a month for life. Now this eliminates the house payment of $800 and also increases their monthly income by $300. The result is an increase of available cash of $1,100 a month over staying in the current home. It's an increase of $500 a month over selling the home and obtaining a traditional mortgage. The owners would get to live out their life in the property or until they moved out. They also would still have $100,000 of equity in the house if they did need to sell it. Still, another option, which I touched on last week, is to supplement your monthly cash flow with a reverse mortgage long before you've depleted all your assets. By using a reverse mortgage early on, homeowners may be able to preserve and extend their liquid reserve. Let me give you an example. Again, this is from Kitces' report. A 72-year-old couple spends $6,000 a month and collects $3,500 from pensions and Social Security. This leaves them a shortfall of $2,500 a month, which comes from their $400,000 portfolio. Now, this is an unsustainably high withdrawal rate of 7.5%. They have a $400,000 home with no mortgage. By obtaining a reverse mortgage, the HECM Saver mortgage, they would receive $1,300 a month for life. Now this would reduce their withdrawal from their portfolio of $2,500 to $1,200 a month, which is a very sustainable 3.6% withdrawal rate. This could conceivably preserve their investment nest egg for the rest of their lives. Because payments from a reverse mortgage don't increase with inflation, and because they use up home equity for current living expenses, a reverse mortgage is always a strategy that you've got to evaluate very carefully. Thus, you need to be careful not to begin receiving reverse mortgage payments too early. The youngest you can be to apply for a reverse mortgage is age 62, but in most cases, it's going to be best for you if you wait till your 70s or 80s. The longer you can wait, the higher your monthly payment. A reverse mortgage is not for everyone, but used wisely and appropriately, it may make a difference in extending your standard of living for many more years and possibly the rest of your life. Thanks for joining me today.